Welcome, everyone, to today's webinar that is presented by PEI, Portfolio Evaluations Incorporated. We're an independent consulting firm focused on providing institutional investment and retirement plan consulting services. I am Brian Higgins. I'm the director of the PEI sales and marketing team. Today's topic is fee leveling, what DC plan sponsors should know. During this session, you're going to have a place to enter your questions. At the end of the presentation portion of the webinar is when we're going to address your questions. Based on the time that we have too. At the end of the presentation, we'll send you copies of the slides as well as an article that the two presenters have authored. So at this time, I'd like to introduce the two presenters, Attila Toth, co-founder and partner of PEI, and Julie Yusko, a PEI senior consultant.
Good afternoon, everyone. On behalf of PEI, I'd like to thank everyone for taking a few minutes out of their busy schedules to hear our presentation on fee leveling. As I think we all know, retirement plan fees continues to be a major topic of discussion. Closely examining these fees has always been strongly suggested by the Department of Labor. However, it was about 7 years ago when the law firm Schlichter, Bogart, and Denton filed class action litigation on some of the largest plans in the country, which captured everyone's attention. Since then, plan sponsors of all sizes realized there are potential consequences of not benchmarking their fees accurately or not at all. Julie and I chose fee leveling as a topic to co-author a white paper and follow it with this webinar for a number of reasons. First of all, recent fee disclosure requirements help plan sponsors understand not only the fees that they are paying, but how these fees are paid for. The overwhelming majority of the plan sponsors that we work with have already documented their discussion and the final decision on their cost structure and understood all the options that were available to them. Second, over the past 5 years, we have seen a noticeable change with our clients. Many of the plan sponsors we work with have shown a great interest in being more transparent with the fees their participants are paying. Specifically, the clients that we work with that are $300 million or more in assets are becoming less interested in offering funds with any revenue sharing at all. Third, only a few days ago, the Department of Labor released their advisory opinion 2013-03A on revenue sharing. Basically, the opinion outlines the responsibilities of plan fiduciaries in deciding whether to approve revenue sharing arrangements on behalf of their plan. We think this is a topic that's going to get a lot of interest, and plan sponsors are going to have to get prepared and document why they got comfortable specifically with any revenue sharing arrangements that they may or may not have. Fourth, very recently there was a controversial letter that was sent out by the Yale law professor to plan sponsors. For those of you on the phone that might not be familiar with the story yet, a law professor at Yale sent a letter to about 6,000 plan sponsors letting them know that based on his research, those sponsors were identified as having potentially high costs. The letter appears to be highly controversial, and some legal experts view his letter as harassment, as he warns that the sponsors, unless they correct the situation, will be twittered in his account sometime in spring of 2014. And finally, I'm very fortunate to be asked to speak at several national conferences each year, and the panel discussion surrounding topics relating to fees always gets the largest audience. At some of these conferences, I've recently heard that some legal experts claim that the methodology a plan sponsor goes through in figuring out how to level their fees could potentially be challenged in the future. So with all the things in the press, we felt that it was a very interesting topic and a timely one to get in front of you with this session.
Thank you, Attila. You bring up some very good points, and as you mentioned, for the past several years, a number of plan sponsors have spent a good deal of their time focusing on fees. Some of this has been driven by the Department of Labor's 408B2 regulation that has required service providers to disclose all the direct and indirect compensation they receive for the services they provide. And this has placed greater responsibility on the shoulders of plan sponsors to determine whether those fees are in fact reasonable. In just the last 2 years, we've seen an uptick in the number of fee benchmarking projects that we've done, and these projects have been done primarily for two reasons. The first, to determine what that reasonable fee is, And second, and perhaps most importantly, to document the process as a fiduciary due diligence exercise, because it is the plan sponsor's responsibility to understand what their costs are and to benchmark those fees. Many of these projects have resulted in savings for their plans, so the next logical question to us has been, well, how do we best capture these savings? While the Department of Labor hasn't really given any guidance on a prescribed method for allocating fees across participants, we do believe it's important that plan sponsors understand that it is their fiduciary responsibility to be aware of how those plan fees are being allocated. Fee leveling refers to looking at the plan's record-keeping and administrative costs and identifying a way of more equitably distributing those costs across your participants. Through this presentation, we hope to introduce to you different fee leveling models and help you understand the implications from a participant perspective. So by means of setting up this conversation, let me give you a little background on the brief history of qualified defined contribution plans. Following the enactment of ERISA in 1974, the first qualified defined contribution plan was established at the end of that decade. It was in the late 80s and early 90s that there was a fundamental transition from defined benefit plans to defined contribution plans becoming the main retirement savings vehicle for Americans. In the beginning, the fee structure of these plans was fairly straightforward, and it was a true example of what you would expect as an equitable fee distribution. Investment costs were kept separate from the record-keeping costs, and fee leveling wasn't really a necessary conversation at that time. Mutual fund companies saw an opportunity and entered the record-keeping business. They approached plan sponsors with what is known as a bundled service arrangement. And in this arrangement, the mutual fund companies offered to do the record-keeping services for, in quotes, free, in exchange for using their investments. But these costs were actually embedded in the expense ratios for the funds being paid for already by the participants. From 1985 to 2002, total retirement assets in the U.S. quadrupled, and we saw the highest growth rates observed among privately sponsored 401ks. In tandem with this growth, the number of mutual funds available for investment also multiplied exponentially, and they benefited tremendously from that growth in assets. As it became unpopular to offer only proprietary funds of the mutual fund company that was providing you your record-keeping services, these bundled arrangements began to unravel, and today the great focus is on the scrutiny around fees. So in trying to simplify the cost structure of defined contribution plans, I'll break it down into two parts. The investment management costs, which are your traditional costs to manage the investment, and it's paid for as a proportion of a participant's account balance. And then your record-keeping and administration costs, which are the fixed costs used to have account maintenance, statements, call centers, the website, and even education. This is a quantifiable target, and this is the number we get to when we do our fee benchmarking projects. This is really the cost that we're also focusing on when we are discussing fee leveling. Plan sponsors are given options for how to get to that target number, and we help design plans that help meet that objective. Most mutual funds are available in several share classes. A mutual fund with multiple share classes is identical in all aspects except for one, the expense ratio. And it's the expense ratio that's fully disclosed to your participants, and so they are fully aware when they are investing in any one of these funds what their cost is up front. However, embedded within the expense ratio can be a number of other costs. So to simplify it, looking at it in two parts, the investment management and revenue sharing, which encompasses the agreement that can be made between a mutual fund company and your service provider to exchange some of the money that is obtained through that expense ratio. In the case of proprietary funds where the mutual fund you are offering is the same as the service provider you're with, it's essentially your investment management arm sharing with your record-keeping arm, but the same concept applies. But this is about as simple as it gets. So this next slide really illustrates a couple of examples to help you understand it a little bit more clearly. The top half of the page looks at the same fund, but offering two different share classes. What you'll notice is that the expense ratio is different for both, and the investment management is the same. The differing amount between the two is the revenue sharing component. So this provides plan sponsors the opportunity, as they are designing their plan and trying to meet that objective of a required revenue target, to dial up and down the share classes to get to that bottom number. Your second example looks at the same exact fund with the same share class, but record kept with two different service providers. What this really highlights is that the arrangements are not equal based on the mutual fund you are offering, but rather the arrangement is between that fund company and the service provider and can differ. So it's something to be aware of. So this really sets up the foundation for our conversation to fee leveling. Fee leveling, as I mentioned before, is the more equitable allocation of a defined contribution plan's administrative and record-keeping costs. It can take one of two forms: pro rata, which is sharing a proportionate amount of those costs among your participants, and it's based on their account balance size, or per capita, which takes that target amount and shares it equally across your participants. The impact to your participants can be significant between the two models, and so it's not surprising perhaps that plan committee members tend to have different opinions on which of these methods is best for their participants. Looking at the pro rata method a little bit more closely, many plans today are designed to have the revenue generated by their investments cover the expected required target by your record keeper. However, the distribution of that revenue is not always equal on a fund-by-fund basis. You may have investments that are covering little or nothing towards that record-keeping cost, and you may have others that are contributing a greater amount. So looking at the goal of a pro rata method is to neutralize that impact so that the revenue attained by each fund is equal and so proportionately shared by your participants. In this example, 20 basis points is our revenue target, and it is equally allocated across your participants based on their account balance. What this highlights on a dollar impact basis is that those with the smallest account balances contribute a significantly smaller proportion of that cost, while your participants with larger account balances are bearing a bigger proportion of those costs. Why this is still considered an acceptable method of fee leveling is if you look at this rather than individuals with differing account balances, but rather as an individual throughout their career. You'll notice that they'll benefit early on, perhaps when it's more difficult to save, with having a lower cost, and then pay for it later as their account balance grows. In the per capita method, we revert back to how defined contribution plans were originally paid for, and many believe that this is the more accurate representation of fair fee distribution, primarily because as we discuss those fixed costs with account maintenance, statements, call centers, those are services that your participants have equally available to them regardless of their account size. And so sharing those costs on an asset-based perspective may not always make sense to plan sponsors as they're looking at this more closely. However, when we look at it on a percent of account balance, the takeaway here is the inverse of your pro rata method, in that your participants with the smallest account balances could be quite adversely impacted by having to pay a hard dollar fee that could be upwards of 10+% of their account balance, and it could be more difficult to achieve savings over time. This also becomes a concern for some plan sponsors who may believe that their plan participation can suffer as a result of this. So these are many of the considerations that go into evaluating what method may be most appropriate for a plan sponsor. So as we look to how the service provider community is started to respond to fee leveling, they've done so in a couple of different ways. One of the first has been that we've observed that mutual fund companies have been launching more and more zero revenue share classes. This provides plan sponsors with the greatest flexibility to implement either or of the fee leveling methods that we just discussed. By reducing the revenue down to zero, then you can apply that asset-based fee equally across all of the investments or charge that flat per participant fee. Secondly, we've noticed that record keepers are enhancing their systems to have the capability of wrapping or crediting back excess fees. And this is to be done on a fund-by-fund basis. In other words, truing up the revenue attributed by each fund to get to that revenue target. So going back to our original example of 20 basis points, if you had a fund that had a revenue sharing arrangement of 15, you could add an additional 5 basis points to true up to 20. Or if you had a fund that revenued 25 basis points, you could credit back 5 basis points and that way achieve your neutral revenue sharing. The capabilities on this are not widely available with all record keepers at this time, and there are plenty of considerations that plan sponsors should keep in mind when contemplating going down this route. One of these considerations is the frequency of those debits and credits. Any frequency that's not done at a minimum of daily can be problematic, and there could be additional costs, and so there's many considerations when evaluating this avenue. Lastly, the record keepers are also providing greater flexibility in the choices for plan pricing. They are more open to discussing pricing your plan on a per participant basis or on that revenue target, providing the plan sponsor the greater information to come to that decision as well. So to conclude, there are some actionable avenues that plan sponsors should keep in mind. First and foremost, a plan sponsor should benchmark their plan's fees if they haven't done so in the last 3 years. While fee leveling is not obligated at this time, understanding and benchmarking your fees is a fiduciary responsibility. In the last 2 years or so, we've done more than 60 of these projects and have achieved significant savings for our plan sponsors, but this has really been the jumping off point that has caused a lot of plan sponsors to reevaluate how the revenue is being collected from their participants. Second, increase your awareness about how the plan's record keeping and administrative fees are being collected. And by this we mean truly understand how the revenue generated by your plan is being collected and what participant populations are being benefited or adversely impacted by those arrangements. Third, explore alternate collection methods and understand their implications and limitations. There's no one correct way to implement fee leveling, and in many cases execution isn't perfect at this time, but you should evaluate those options and understand why they may or may not work for you. Lastly, identify the fee collection arrangement that most closely aligns with your philosophy regarding fees and work towards that objective. You want to document that process so that you have that paper trail that you've gone through this exercise.
So at this point in the webinar, we want to address some of the questions that you folks have provided us. And the first one that I think everyone may want a little bit more clarification on is, as a plan sponsor, am I obligated to do fee leveling?
Well, the simple answer is no. There really hasn't been any clear guidance provided around plan sponsors' obligation to ensure equal distribution of these costs. Participants are provided the all-in cost through the expense ratio of the funds that they're invested in, and they may not have the full knowledge of what the breakout is of those fees, but they're going in fully aware of what the fees are when they pick an investment option. Though I think through the comments that Attila made earlier on, you may lead to think that this could be the next area of focus from perhaps a litigation perspective, as these fees are hurting some participants in terms of the savings that they're able to achieve.
Another question that we received is, how do I pick which method is right for my plan?
I'll take this one. It's a question that we're asked quite often from our clients. I think it comes down to really a philosophical belief. One of the exercises that we've helped our clients conduct is really looking at their plan demographics and using different angles to determine the impact that a change in their structure would create, and what percentage of the population would be either positively or adversely impacted. It's an interesting exercise and one that could help the plan sponsor decide which method is more appropriate for them.
Okay, thank you, Attila. Another question that we received is, what if it's not possible to construct a plan lineup that fits with a fee leveling approach?
Well, at this time, the execution of fee leveling is often not perfect, but generally speaking, you can get pretty close. Our opinion is that when the plan committee identifies the method that they feel most closely aligns with their beliefs on that distribution of fees, that they should work toward that goal. They may not get it perfectly initially, but they should get as close as possible and continuing evaluating opportunities to get closer to that goal.
Thank you, Julie. So we have a fourth question, too, that we want to address. If a plan chooses a per capita approach with a plan that has a large disparity between large and smaller participant account balances, could the plan be accused of not acting in the interest of participants with smaller balances?
Well, I think it goes back to, as I mentioned earlier, and perhaps the question was raised before I had mentioned what some clients are asking us to do. I think going through that exercise really helps the plan sponsor determine, what percentage of the population and where that kind of break point is. However, we have plan sponsors that have gone through that exercise and have, selected one just because of the philosophical belief that they believe, regardless of what the results of that analysis was. So I don't really think that there's much of a concern or much exposure for a plan sponsor picking either side.
Okay, thank you. And another question that we received, are the fixed admin costs, including the total expense ratio, part of the revenue sharing, as they are included in the investment management fees, as they are not included in the investment management fees?
So if I understand this question correctly, fixed administrative costs are completely separate than the stated expense ratio. The revenue sharing that's embedded in the expense ratio helps offset those fixed administrative costs. I think that's the answer to that question.
Okay, thank you. And one more question. Attila, you had mentioned in your opening the IRS DOL notice that was released in 2013 that provides guidance on this topic.
Yeah, this just came out a few days ago, so I would suggest for those of you interested in learning more about this to get in touch with your outside ERISA counsel. But it's basically an advisory opinion letter, so it's something that we will be watching very carefully. And basically, what it comes down to is the use of ERISA budgets. So for those organizations that have excess revenue sharing than what their record keeper currently needs, there's a lot of scrutiny on what that excess is, how it's used, and whether it's prudently been put together. That's my understanding of what this opinion letter is. Again, I'm not an attorney, but I would suggest you contact your attorney to find out more about how you can perhaps better protect yourself if this becomes some sort of regulation in the future.
And one final question we have there been any audits on fiduciary issues related to the pro rata method? And is this method more risky for plan sponsors?
So there really haven't been any fiduciary issues raised related to the pro rata method at this time. It really is, for the most part, no different than how plans are managed for the most part today, in which the revenue generated by particular investments are used to offset those fixed record-keeping costs. If anything, the pro rata method, if you continue to pursue that line of an asset-based fee, neutralizes the playing field so that all investments are contributing to that cost, rather than it being that only a handful of funds are offsetting the cost for those that are not contributing at all. So I wouldn't view this method as being more risky for plan sponsors than anything that's being done today.
Yeah, and I would also add that there's a lot of in-betweens here. We work with some clients that have a per capita method, and again, when they saw the original impact to those individuals that were just starting out and specifically those individuals or participants that had very low account balances, they felt concerned for them. So what they were able to do was work with their record keeper and waive any type of record-keeping fee for those individuals that were new to the plan and started implementing some sort of record-keeping fee after the first year. We have other clients that have a certain minimum account balance where they are waiving the record-keeping fee, and the record keeper is able to determine at what point a record-keeping fee should be imposed on the participants. So there's a lot of different ways that you can approach it, because I know that specific version is concerning to those younger folks.
Okay, so that concludes the Q&A part of our session, and it concludes our webinar for today. Again, we thank you for taking the time out of your busy schedules to attend. As I mentioned at the opening, we'll send you a copy of the slides and the article that Attila and Julie wrote. Please feel free to reach out and contact Attila and Julie if you have further questions. Thank you very much.
Thank you.
Thank you.